Happy Friday, folks. It's Shayan with Integrity Home Mortgage, back with your weekly rates rundown for February 20th, 2026. So, this week was shortened by the President's Day holiday, but it kind of felt more like the Christmas holidays. Volatility was low, mortgage prices held within a very tight range, and headlines were tame. That is until today. And I'm not one to make mountains out of molehills, but I'm going to sort of do that today because this lull in action may not last for much longer. And we'll get to that in a second, but let's start by taking a look at our benchmark numbers. 10-year Treasury yields are higher by 3 basis points to right around 4.09%, and mortgage rates are higher by just under 5 basis points from where we had them last Friday. Let's start with a mountain of a news story that's really kind of a molehill when it comes to market impact. In a 6-3 vote, the Supreme Court ruled IEEPA tariffs to be unconstitutional. Now, IEEPA tariffs are the stiff and sweeping reciprocal tariffs placed on places like Mexico and Canada and China that the administration put in place specifically to try to stop the flow of illegal drugs. The other tariffs around like steel and aluminum and automobiles and things like that, those are not IEEPA tariffs. Those are done under a different vehicle, and those are going to remain in place. So it sort of begs the obvious question, and that is what new tariffs will the administration introduce, given how foundational tariffs have been to both trade and foreign policy? And also, will every country out there that has agreed to a trade deal now want to come back to the table to renegotiate? Well, the answer to those questions are I don't know. This is econ, not poli sci. So let's focus on the economic impact, or at least the potential economic impact. And as we do that, let's keep in mind the scale, right? The U.S. is a $31 trillion economy, and IEEPA tariffs have so far collected a total of about 175 billion. So when we think about the scale of the impact, think about it in that framework. On balance, this should reduce inflationary pressure at the margin, but it's really unclear how much, given the fact that we know nothing about replacement tariffs, which are almost certainly going to be introduced. This is likely going to result in higher deficits because tariffs were supposed to offset some of the increased spending due to the big, beautiful bill. Uh, the deficit was $1.8 trillion in 2025. So, again, the net impact of IEEPA tariffs going away is kind of a drop in the bucket. Refund chaos. Even if a different route is pursued to introduce tariffs to the exact same degree that we had in the IEEPA tariffs, the $175 billion that's already been paid under IEEPA, those are all subject to a refund now. That law is pretty clear. That money has already been spent, which brings us to higher treasury issuance. They're going to need to issue more treasuries in order to bridge that gap in revenue. And that is a place where long term interest rates are pretty sensitive to the level of issuance. More supply in treasuries equals higher rates. So, what should we expect a response out of the FOMC? Well, reduced inflationary pressures are probably real, although those are already being seen by the Fed as being transitory. But net net, this is going to kind of feel like a tax cut to the U.S. consumer. Prices are going to drop, presumably, and that should spur more growth. Under a Kevin Warsh FOMC, it's kind of assumed that that this FOMC has a easing bias. I mean, they're inclined to lower rates a bit from here, but more growth and less inflation is kind of the perfect recipe for the Fed to do nothing at all. So far, the market reaction has been very muted, which isn't surprising given this mountain of a headline from a policy perspective, but kind of a molehill in terms of economic impact. So the theme thus far in 2008, which we discussed last week, remains intact, which is multi-year low in mortgage rates. Now is a great time to refi if you haven't already and you've gotten a mortgage in the last 3 years. But before we end, we should also look at a story that is kind of a mountain that's getting treated as a molehill at the moment. Data this week was pretty light, but we did get a couple of important pieces this morning. Core PCE, which is the most influential measure of consumer inflation when it comes to the Fed's decision making process, came in higher than expected at 3% year over year. That's the highest reading since December of 2023, and needless to say, it's moving further away from the Fed's 2% target. Also, Q4 GDP came in significantly lower than expected at just 1.4%. We were at 4.4% in Q3. Now, some of that drop can be attributed to the government shutdown impact, but the consensus estimate, which takes that government shutdown into consideration, was for something closer to 2.8%. So that's a pretty big miss. This data from this morning is kind of getting lost in the SCOTUS shuffle, but this is not great for rates. Recent jobs data has been strong. Falling growth and increasing inflation at a time when tariffs have been flat is not what you want to see if you're a prospective home buyer or a mortgage professional. These are measures that cut across the entire economy, not just 175 billion of it. One data point doesn't exactly make a trend, but these are news items that I think are definitely worth keeping an eye on in the coming months. That's all I got for you this week, folks. Have a great weekend, and we'll see you next time.